The floor is yours. Yeah.
Okay. Welcome everyone to Accounting Design Project virtual event. My name is Song-Yi Han. I'm the moderator of today's session. Before we start it, let me remind you of a few housekeeping rules. First, please unmute yourself while you're not speaking so that we're not going to be interrupted by unnecessary background noises. However, we would really appreciate if you can turn on your camera so that we can have interactive discussion. Second, if you have any question, please raise your hand using this feature in this app so that Stefan will call on you. Finally, we are going to let the speaker have the first 5 minutes uninterrupted presentation so that he can brief his paper in the beginning of the presentation. So without further ado, let me introduce today's speaker, Stefan Huber from Rice University, and he's going to talk to us about the effect of goodwill accounting on the market for corporate control. Stefan, the floor is yours.
Thank you so much for the introduction, Song-Yi, and thank you everyone for taking the time out of your well-deserved lunch breaks. I think for most of you, the same for me, to hear about my paper on the economic consequences of goodwill, which is joint work with Charlie McClure from Chicago. He and I were actually PhD students together, and that's how we also got started on this paper about over 2 years ago now. Without further ado, I don't think this is not the audience where I need to make much of a case for why goodwill accounting is important. But if you sort of look on companies' balance sheets in the United States, you will see that goodwill will by large be the largest intangible assets that you can find. So we're talking about roughly $5 trillion or almost 7% of all assets of publicly traded companies in the United States. And even if you were to just zoom in into a particular takeover, you'll see that a large portion of the purchase price, roughly 40%, is typically allocated to goodwill, which means how we account for goodwill has significant implications for the earnings reported by the joint entity afterwards. And because of that, at least ever since the first big merger wave started rolling in the 1960s, reforming the accounting for goodwill has been a priority for standard setters. However, whenever goodwill reform comes back on the table, which at least for the short period of time that I've been alive has sort of been every 10 years, there comes a lot of opposition with that. And the opposition is usually around economic concerns that if you change goodwill accounting, you'll change the allocation of capital within the economy, which can in particular distort the allocation of capital to those industries in the economy that are sort of most vital for growth. So the industries where merger activity is the most vibrant, those are the industries where changing goodwill accounting, and in particular changing the goodwill amortization, would have potential negative effects. Those are sort of the economic concerns that we've heard, and one of the quotes is sort of shared from comment letters back when the current standard was debated and then introduced around the turn of the millennium. And from the backdrop of these concerns, we were simply asking the questions like, what are actually the economic consequences of goodwill accounting for the market of corporate control in the United States? And in order to answer this question, we design and then estimate a structural model of corporate takeover auctions. Now, what is the reason that we go structural? Well, when we look at mergers, the only thing that we can see are merger outcomes, meaning the merger prices, the realized prices. However, those realized prices are equilibrium objects that are jointly determined by the underlying valuation of an acquirer for the target and the competition that the acquirer faced when trying to acquire this target. If accounting matters, it should matter for the valuation of the individual bidder. And so what we would need to do is actually disentangle this valuation and the competition effects in order to actually figure out what is the role of goodwill accounting in the valuation of these targets. And using the auction format together with a structural model allows us to do that. And once we've then disentangled these two components, we can then use the structural model to counterfactually simulate what would happen to takeovers if we were to superimpose alternative accounting standards. And the alternative that we'll look at here in much more detail is an alternative where we do goodwill amortization over a set period. Now, what do we find? The estimates of our model imply that under current impairment-only rules, accounting-sensitive acquirers, think strategic acquirers, act as if they only internalize 85% of the purchase price that they're paying. The reasoning behind that is that these accounting-sensitive acquirers exhibit a functional fixation on earnings, which lets them not care fully about cash flow. And because of the goodwill impairment, they can delay a significant portion of the purchase price that they're paying until an uncertain later date when they actually realize the expense. But that deferment lets them not internalize the full purchase price. Now, this means if we move to an accounting standard that starts expensing goodwill right away, for example, a 10-year amortization, they would start internalizing more of the purchase price that they're paying. And as a result, our counterfactual results show that deal premia over the market price of the target would sort of reduce by 5 to 6 percentage points, which reduces overall deal valuations or the overall merger and takeover market by about 4%. If you aggregate this up in the entire merger market, that would aggregate up to about $68–70 billion. But it's not just the entire pie that is shrinking in our counterfactual simulations, but we also see who ends up acquiring companies changes, because we see private equity and financial bidders who by definition are sort of less sensitive about future earnings numbers and who only care about fundamental value. Those become much more likely at acquiring a particular target because the accounting sensitive public acquirers become less aggressive in bidding, and we sort of see an increase in private ownership by about 7.5 percentage points, sort of increasing the amount of assets that they can acquire by 21%. And I see Barrett having already his hand up.
Hey, Stefan. This is not a particularly technical question, just on this slide. I'm curious to know your thoughts on how you would kind of weigh these different descriptives or projections, against one another. Because on the one hand, you could say that a reduction in the deal premium maybe is a good thing, right? Because it's reducing the overpayment, which could be, kind of a dead weight loss. But then, you pit it as private ownership. Maybe, I don't know if that's good or bad. I'm just curious to know, your thoughts on how you would kind of weigh these outcomes against each other.
No, that's an interesting question, and something that we're still sort of thinking about actively to get some sense of that. Because on the one hand, over the past years, we've seen sort of the SEC being concerned about reducing the publicly investable universe and moving into the private space, because that obviously has negative implications for the investable universe for a significant portion of the economy. On the other hand, we sort of working to add in some results right now that sort of point into the direction that we see the more accounting sensitive, the more earnings fixation an acquirer exhibits. That tends to be a function of a corporate governance failure. And from that perspective, you could think about the private ownership increasing also as a good thing if that sort of if that leads to sort of a more efficient allocation of capital. However, like we can't. That's sort of how we should think about weighing those two components. Can we make a statement about overall welfare effects? That's beyond the paper, unfortunately. But I agree with you. We should. Like, there are implications that we need to think through, like much more deeply. Okay, these are sort of the headline numbers that changes, but the welfare implications, we can't speak to that directly. But I hope I've sort of given you sort of the main notes you would want to hit on for to answer that question. Okay, so how do we get at these results? So bear with me. So we'll be technical for about 2 slides, and I'll try to not to be too technical after that. So the main assumption, or the key assumption in this paper, is that we think about 2 sources of value in an M&A transaction for a particular bidder. And when we think about a bidder, we think an acquirer, and we think the management of the acquirer making that bid. And so what do they care about? They care about the fundamental value, which is obviously discounted cash flows. But for either capital market pressure reasons, myopia, or contracting frictions, they also care about the future earnings stream that they're acquiring. And so because of that, they will place a relative weight on those 2 components, and we call it weight W. And that weight is sort of what will drive the majority of our results, and that weight is what we need to estimate in order to get our counterfactual results and the results that I've just presented. So we have a weighted sum of cash flows and earnings, and obviously earnings are just a function of cash flows. And the way we think about this here is that earnings in a particular period are essentially cash flows minus accrual expenses. And in our case, that is to what extent an accounting standard A maps the premium, or like the price B that they paid for an acquisition into future accrual expenses, either through amortization, depreciation of tangible assets acquired, or in case of goodwill, that would be an impairment. And so if you sort of add this together, and I'll spare you sort of the tedious math to get there, you can sort of then rewrite the surplus that an acquirer gets from a takeover as the discounted future cash flows, the fundamental value V, minus the purchase price B, but only to the extent that the acquirer internalizes this purchase price. To what extent does the acquirer internalize the purchase price? Well, with a weight 1 minus W, they internalize the cash flows. Just care about fundamental value. And with a weight W, they care about how the accounting essentially maps the purchase price into future cash flows. And so overall, the purchase price B will be internalized with a weight cap A that is a function of the earnings preference, how much goodwill they allocate, and the accounting treatment of goodwill. And so here, so the nice thing in the surplus is we can observe how much goodwill is allocated. We can observe the accounting treatment and the incidence of impairments, but we cannot observe the earnings preference. And so the earnings preference is what we need to estimate here. You may see your hand.
Yeah, so Stefan, I have a question. It's like when you model based on these 2 slides, it seems like the preference is mainly coming from the income statement or cash flow numbers. There's no balance sheet, asset composition information in the bidders or acquirers objective function. But I think in the M&A, there's a literature about asset complementarity, is that the same piece of land or factory may have a different utility or value depending on some strategic acquirers in the industry. Some competitors are able to leverage that same physical or intangible assets better than others by combining it with the existing network of assets. So I want to hear your thoughts on why there's no at least balance sheet type of the asset composition into this calculation, and potentially you may find the opposite results, that the non-private equity acquires, strategic acquires from related industries are actually better to internalize the acquisition better than just a pure financial motivated acquisition.
No, there's a great observation, Ayung. And effectively, what you're talking about, these complementarities and synergies, they're also baked into this acquire surplus. And I'm going to talk about how we're going to do this in a little bit more, but let me give you the intuition here. So when we're looking here, what you think about asset complementarity, that's based on the fundamental value of the company. And the fundamental value might be different to different bidders, because different bidders might have different levels of synergies. And I think that's sort of what you're referring to. And that would be captured in differential fundamental value. So that would be the V part. So the income statement portion only matters to the extent that you internalize the price. So that's the A part. But sort of these actual fundamental economic valuation implications, those come from V, and we allow bidders to draw different Vs. We also will estimate the Vs, and we also assume, and by that we follow prior literature, that strategic and financial investors have differential valuations that are drawn from different distributions. So we'll account for that. Steve.
Yeah, I guess there's something I don't quite understand here. You got the infamous summation here. The notion we have is that earnings ultimately align with cash flows. Okay, earnings equals cash flows over a long horizon, so that eventually you're going to have some, to get the alignment, you're going to have some goodwill impairments or amortizations to get that alignment. Yeah. So I don't see it quite working here. Maybe you're thinking about a short-term horizon, the manager's lifetime expectancy or his tenure expectancy, but I didn't see it on this with this infamous horizon summation.
So the reason why, so we follow clean surplus accounting, so that the sum of cash flows is equal to the sum of earnings over the long horizon. Mm-hmm. What you'll sort of see is that the accrual accounting changes the timing of the earnings relative to the cash flows. And in our specification of how the value is written, that we're looking at the expected future discounted cash flows and the expected future discounted earnings. And that's what's giving you a differential result here. And the reason to motivate that is essentially one that you're also just said. It's sort of a manager that acquires the company after, in our sample at least, after 6-7 years, most of them are no longer part of the company, and so their compensation is no longer tied to that. And that sort of justifies for us to look at it through that analytical lens.
Yeah, I guess over a certain time period where the earnings and cash flows aren't aligned, but in the long run they're all aligned, okay? And actually, you cannot take the present value of earnings. That doesn't work. You've got to take the present value of residual earnings. But you can't just discount earnings. You capitalize earnings because it's a flow number. So I don't quite see whether technically you're set up.
Ayung.
Sorry, can I ask you another question? So, like, do you distinguish? So, when you talk about cash flow, do you distinguish cash acquisition versus stock acquisition? So,
I will get to that in a bit. So, in order for let's see what so in our sample are all cash acquisitions.
Oh, okay.
And we need all cash acquisitions so that we can actually figure out what the underlying valuation is.
Okay, so all the acquisitions in your model are all cash acquisitions. So in terms of a cash flow, everyone prepay, right, for goodwill?
Everybody prepays.
And then you're comparing when that prepay is going to show up in earnings. So that's
right. Yeah.
Okay, thank you.
So this is our formulation of the surplus. And so we want to figure out sort of like, we need to know how much does a bidder value the target, and the value depends on the fundamental value and to what extent they internalize the purchase price paid. And so in these auctions that we're studying, the bidder then wants to maximize their expected surplus. So valuation minus price paid and how much they internalize times the probability that they will win the auction. They will make the bid for the target accordingly. And so the nice thing is, looking at auctions give us a strategic interaction that tells us how these primitives of the model map into observed bidding behavior. And then we can observe those bids to reverse engineer what were actually the distribution of values and accounting preferences of these bidders. And the setting that we're using are corporate takeover auctions. And they're unfortunately not the easy type of auctions that we all know from Sotheby's or eBay, but they're a little more complex, unstructured creatures. And so just to give you a quick sense of how they go, so if a company decides that they want to put themselves up for sale, they usually hire an investment bank. The investment bank will come up with a list of potential acquirers for them, and will reach out to those acquirers. And if they decide to join the auction, these acquirers, they will sign confidentiality agreements. And then the bidding typically proceeds in multiple stages, meaning the company will share some information about the fundamentals with the bidders. The bidders will submit typically informal bids in early rounds. After each round, the target company will sort of prune down the bidder pool, and until a final round arrives, where typically 4 to 2 bidders are left. And those bidders at that point have to make committing bids in marked up actually merger agreements. And the target company will then select typically the highest bidder as the winner of this auction. However, this structure is not only dynamic, but we sort of see frequent exits and re-entry of bidders. And especially at the final round, we see a lot of negotiations happening, especially then with the picked winner, to get them to raise the price even more, which means standard auction models cannot really describe these takeover auctions. And so we, Barrett.
This is just a clarifying question, but in these situations, the bidders can't see the other bids, right?
The bidders can't see the other bids, but at the end of each round, the remaining bidders tend to have a very good sense of what is the bid to beat at that point in time. So we actually see a lot of information sharing from the target to the bidders, getting them to like adjust their bids into the right direction. And so corporate takeover auctions have been studied in the past, and so we follow prior literature in econ and finance, Heile and Tarman, Gorbenko and Malenko, and we rely on 3 assumptions that help us with identification here. The first assumption is that no bidder would ever bid more than the value for the target. So they wouldn't submit a bid that would leave them with a negative surplus. Second, a bidder would never allow another bidder to win that they could beat and maintain a positive surplus. So that goes directly to Barrett's question. So they wouldn't let that happen. And then third, because we see so many informal bids in the initial rounds, where bidders essentially just give ranges and they're not really committing at that point in time. So that's an assumption, and coming from Gorbenko and Malenko is we also assume that a bidder would not make an informal bid if even at the current market price of the target, they would have a negative surplus. Now, these 3 assumptions together give us set identification, and then we need to add distributional assumptions so that we can get actually point estimates for the distribution of the fundamental values and the accounting preferences. Now, I want to give you some intuition of how these assumptions help us identify the parameters that we care about. And for that purpose, think about the valuation for a target that a bidder has as a multiple of current stock price. So 1 down here on the x-axis would be equal to the current stock price. And so now what can we observe? We can see the winning bid, B1, and B1 will obviously be higher than the current stock price. And so what does this tell us about the valuation of the winning bidder? Well, that tells us that the winning bidder must have had a valuation higher than how much they bid. So it tells us something about this right-hand tail of this distribution. Now, what about a losing bid that we observe? Well, from the assumption 1 and 2, we know that the losing bidder's valuation must lie between their bid and the winning bid. Because if it wasn't in between there, if it was below, they would have bid with a negative surplus. If it was above, then above the winning bid, then they should have won the auction. If we see an informal bid, we only know that the price, the value is somewhere between the current price and the winning price. We see a lot of bidders never submitting a bid. The only thing we know about them is that their valuation must be below the winners. And then we see actually companies dropping out and noting that it's not worth for them to bid because even under current market prices, it wouldn't be worthwhile to acquire the company. And so taking all of these bid informations together, we can sort of map out how the empirical distribution of underlying valuation should look like. And then we need to find the parameters that can best describe this distribution. And I don't know who's first, so I'll take Ayin first.
Sorry, John. So as you are going through this, I think there's a JFE paper published by my former IU Indiana University's colleague, and he tried to model that multiple bidders and also the target company, they all receive different private signals about the potential synergy or asset complementarity can come out from this deal. And he tried to model that how a sequence of the bidding events will actually indirectly exchange those private information, but eventually everyone is drawing from a different underlying information sets that signals a very different distribution in terms of what this model is. So is that something kind of like you have in your model is, or you're assuming everyone actually receiving signals or valuing the fundamental based on the...
So we haven't modeled sort of the information acquisition.
Okay.
What we're sort of modeling is that in the end, so there will be strategic bidders that we can observe in the data and financial bidders. And what we just say, okay, what is the end sticker valuation that these people have? And we assume that strategic and financial bidders will have that valuation drawn from two separate distributions.
Okay.
But we're staying agnostic of what the information was that they acquired and what the process was that formed that valuation.
And do you impose anything to make sure that strategic and financials bidders' value distributions actually are significantly different from each other? Is anything that you assume?
So we don't impose that. So we let the data tell us whether they're different. Prior research has shown the valuations are different, and I will have a slide just in a bit that also talks about how they differ.
Okay, thank you.
John.
Yeah, I'm just trying to understand how much heterogeneity you're allowing for in this distribution across different firms. Is it one distribution for everyone, or does every firm have its own distribution, or is it something in between?
Okay, that's perfect. So let's jump right into this slide because that talks about that. So what we're allowing is that the value is drawn from a log normal distribution, and we assume that this log normal distribution varies by bidder type. So we allow the values for strategic and financial bidders to be drawn from different distributions. And the distributions then also vary differently with target characteristics. So that's the valuation differences that we allow. And then the second difference is that for the strategic bidders, public firms, there we assume unobserved heterogeneity in their preference for earnings versus cash flows. So that's the extent of heterogeneity that we're allowing here. More heterogeneity would make estimating the parameters impossible. Now, how do we estimate it? So we estimate the parameters of all these distributions using a method that's called a simulated maximum likelihood that allows you, like, it's essentially a maximum likelihood estimation that you can use when there is no closed form solution for the log likelihood. And I see, thank you, Ayun, for putting that in the chat. Okay, so what's the data that we're using? So first, obviously, we're using auction data on corporate takeover auctions. So for that purpose, we started with the STC takeover universe since July 2001 until September 2022. We focus on all cash deals of non-financial public targets in the United States. Why is it public targets? Because for the public targets, when they're in the takeover, they usually need a shareholder vote to approve the takeover. And this means in the proxy filings or the SETOT, we actually can observe the entire merger backgrounds of these mergers. And so from these SEC filings, we then identify whether these all-cash deals were an auction or negotiation, based on whether there was one acquirer or whether they talked to multiple bidders. Once we've identified the auctions, we then go into the backgrounds and actually collect details on every single bid that has been submitted in the bidding process. As I said, sample period is between 2001 and 2022. We then get purchase price allocation data from the deal stats database and complemented with hand-collected PPAs from 10Ks whenever deal stats was missing. And we need to get a sense of the impairments. And for that, we use the entire CompuStat universe in that time frame as well to get a sense of the cross-sectional distribution of impairment incidents and impairment sizes whenever that's necessary. So what do we find? I'll start with the most important parameter of our model, which is the distribution of earnings preferences, W. So we assume this follows a beta distribution. And what we sort of see is that there's a lot of weight near the low values of W, meaning by far and large, acquirers care mostly about the fundamental value and not the future earnings stream that they acquire. So on average, acquirers value earnings roughly 3 times as much, value cash flows 3 times as much as future earnings. And so if we put that together, this has then implications for how they value the targets. So following prior literature, we estimate different valuation distributions for financial and strategic bidders. What we sort of find, and that is in line with prior literature, the expected value of these distributions, strategic bidders tend to have a higher expected value because, as Ayun pointed out earlier, well, they're the ones that have synergies, versus the financial bidders, typically in expectations, their synergies aren't as high. And so the mean of these distributions are like 7% or 1% over market value of the target. However, just based on fundamental valuation, so purely cash flows, financial bidders have a higher dispersion of this distribution than strategic bidders. But now what happens when we put in the earnings preferences as well? under the earnings preferences, strategic bidders act as if they only internalize 85% of the purchase price that they're paying. And if you only internalize 85% of the purchase price that you're paying, well, then that's equivalent as if you had valued the target 15 or 16% higher. And so because of these earnings preferences, the distribution of the strategic bidders shifts to the right and becomes much more varied. And so we see the strategic distribution sort of moving to the right and becoming more dispersed here on this slide. Now, what does that mean? So it means that if strategic bidders were to only care about cash flows and not earnings, their valuation for a target, or the willingness that their willingness to pay for a target, would be 15% lower than under current accounting rules. But that's just the underlying valuation. How would that translate into actual observed takeovers? Well, that depends on the competition that they face when bidding for the target. And if we take that bidding into account, we would see a roughly 10% reduction in deal values under everybody just caring about fundamental value, which is sort of a first best type of counterfactual. So this means, like I'll get to Barrett in like a second, this means while the underlying valuations drop 15%, because of competition from less accounting sensitive acquirers, like private equity firms, deal values will only reduce by about 10%. So filtering through 2/3 of that valuation change. Barrett.
So caveat by saying I haven't done research in this space, and so I don't know the data, but I'm curious to know. So this essentially implies that strategic acquirers overpay by nearly 10%. Does that kind of agree with research that's been done on goodwill impairments in terms of the size of impairments over time? Can you look at that, separate buyers into strategic and non-strategic like you've done, and then see what goodwill impairments have looked like kind of over that time frame?
So splitting them in strategic and non and financial is sort of a little tricky, because for the financial ones, like the private equity firms, we actually cannot see what they do with the targets. To give you some sense of the impairment magnitudes, in the cross section, the likelihood of having a goodwill impairment is roughly 10%, at which point on average like 30% of the goodwill balance is impaired. In terms of what you see sort of in the time series, and that is very hard, because when you sort of acquire a company, the goodwill has to be allocated to a business unit, and then you have to sort of do the impairment test on the business unit. And so for roughly 60% of companies, you actually cannot track what happens to the goodwill relating to a particular acquisition. Jake Thomas and James Potapa have a paper where they sort of painstakingly went through S&P 500 acquisitions and sort of tracked for 10 years. And so over 10 years, only 25% of all the goodwill acquired of all these transactions actually experience any impairment at all. So there's very little impairment that happens within the first 10 years after acquisition.
Yeah, I'm just curious, like trying to think of if there's any way to reconcile the magnitude of what you're finding with any outcomes that have been observed, right? Because it would, if you don't find that that's particularly close to what is observed in the real world, then either the model is, off some, or there's a bunch of impairments out there that haven't been taken or have been masked, or whatever the case might be. So Anyhow, thanks. I appreciate that. I was just curious to know how that kind of jives with statistics that have been documented on actual
But
impairment.
let me, and then I'll get to John. Let me quickly talk about the amortization counterfactuals, and then I'll actually have a statistic that can directly potentially speak to your question. So if we look now, because the cash flow counterfactual is sort of a hypothetical, what is really interesting is, okay, what would happen under a 10-year amortization regime? And that can be either amortization only and we don't test for impairment, or we have an amortization regime where on an annual basis, we still test for impairment, and sort of the impairment frequency is sort of happening the same way as it is right now. If we superimpose that, what we sort of see deal values reducing by 4 to 4.3%, depending on which amortization standard you choose. And it comes down to sort of a reduction in deal values of about $70 billion. Overall, just showing that competition among bigger types actually matters and moderates this valuation changes. And so now you could go back in time before ASFA's 142. And at that point in time, companies also were allowed to choose pooling of interests. So under pooling of interests, and my memory is hazy from them because I was 8 years old when it got abolished, is that essentially at that point in time, companies were allowed, if they combined and fulfill certain criteria, they could take the assets and liabilities at the current book value on their own balance sheets. So there wouldn't be goodwill created, there wouldn't be a step up of assets, which was preferential. And so oftentimes most of the time companies actually went to the SEC beforehand to ask them whether that particular deal would fulfill the criteria for pooling of interests. And research, and so you could even see merger documents where you sort of saw price if pooling gets approved and price if we have to use purchase accounting. And research from that period sort of shows the difference is roughly 10% in how much they're willing to pay if they can have pooling versus purchase accounting. And so it seems like our results sort of are sort of in that order of in that same ballpark.
John, do you have a question?
I'm good.
You're good. Okay. So Stefan, I wonder that if you can kind of take advantage of the richness of M&A data to kind of test some of the incentive hypothesis. So right now your story, maybe I understand incorrectly, but you seem to say that compared to cash flow accounting, when we don't book any assets, accrual accounting would decide when to kind of like write down, impair, or those goodwill that we recognize at the time when the acquisition occurs, right? Can be indefinitely in the future or impairments based on whatever straight line schedule, right? And if the acquired firm actually cared about earnings, then not impair at all will be always better because their earnings were always elevated. But I think what you document here based on only cash acquisition and also public target is probably not the area where you are going to document the biggest effect, because if you look at the stock acquisition, those are the acquirers actually try to take advantage of their cheap currency to actually acquire many other companies when their stock price is actually very high. And also when they are acquiring private targets, there's a much bigger information asymmetry, especially when the acquirer is a publicly traded company, much bigger than the small venture. And you probably will see certain different variation, and then that can tie with how much the acquirers actually cared about earnings across different samples. Right now, you pick one sample, which is actually a very small fraction of all the acquisitions in the US, but you are let go probably, I say 90+% of the transactions over your sample period. But cross sample will give you a lot of a richness of the data. Seems that your model is kind of like heterogeneity across acquires fundamental value is all data driven, right? It's not something you ex ante model with. So I encourage you to take advantage of the different acquisition samples. Yeah.
No,
But
I agree that we're sort of picking a very specific setting, and let me explain to you why we take that specific setting. So if like our intuition would be that if we were to also look at stock-based acquisitions, we would actually expect these effects to be actually larger, for example. But the reason why we focus on the stock-based, on the cash-only acquisitions and private targets is this is the only way we can actually get a handle on identification of these underlying parameters. Because what our identification strategy really relies on is the fact here that we can observe the true value of the winning bid. And if it's in cash, there's no uncertainty about what the value of the winning bid is. If we, for example, were to look at a stock-based acquisition, we can see what the value of the stock is at the point in time that they're bidding, but we don't know what actually is the value that the bidder assigns to the stock. So that would sort of make this upper bound, which is the winning bid, an unreliable assumption for identification. And at the same time, we need the actual value of the target to get a sense of the lower bound of the value of the management under current, the value of the target under current management. And so while we would like to expand our sample to have to be richer and also include the stock-based acquisitions as well as private targets being acquired, if we do that, our anti-identification strategy would no longer work. And that's sort of the reason we focus on the target, on that sample, and follow sort of prior literature on that.
So a follow-up on that. So I think that limits the contribution, the implications of what you can inform us, right? Like the paper becomes accounting for goodwill for a specific situation. Is that a fair?
I think it's a specific situation where we can observe the bids. Now, do I believe that the bidding? I do not. I still believe that the incentives that are there, if we have stock-based acquisitions, are very similar, and I don't think that the valuations that the strategic versus financial bidders would acquire are different, because what we don't restrict ourselves to is like we just restrict ourselves that the winner didn't make a stock-based acquisition. In our sample, we still have a lot of acquirers that end up losing, that make a bid that includes a stock portion. So I don't think that restricts the implications too much, or the applicability of the research. Okay, so where does this change in valuation come from? It comes from two sources, both on the intensive and the extensive margin. The first part on the intensive margin, we see that bid premia that are paid over the current stock price of the target would go down. So in our sample, we sort of see under impairment bid premia around 44.9%. If we were to superimpose an amortization standard, bid premia would drop down to roughly 39%. So that's like 5 to 6 percentage points reduction here. But we also see changes on the extensive margin, meaning the probability of deals that would fail, meaning auctions where you don't find an acquirer willing to even pay the current market value of the bid, would sort of increase by 20 basis points to 2% from 1.8%, so a 10% increase in the failure rate of these takeovers. So both on the intensive and extensive margin, we see sort of reductions here. And then in the end, we also see distributional effects. Under impairment rules, we see about a third of auctions being won by private equity firms. If we move to goodwill amortization rule, what happens? The strategic bidders that care about accounting and future earnings now have to internalize more of the purchase price that they pay at an earlier point in time. And so then they become less aggressive in their bidding, which opens up room for private equity and financial bidders to swoop in and win more of these auctions, increasing the probability of them winning an auction by about 7 to 8 percentage points. And so overall, if you then count the value of the assets that these private equity firms acquire, we would sort of see a 21% increase in the values of assets held by financial bidders. And so we sort of try to make the point that goodwill accounting not only has an effect for the size of the takeover market, but also for who wins and acquires these targets and productive assets in the economy in the end. Now, I still have a few minutes left, so before I want to close, I want to share sort of a last counterfactual with you, which I usually don't have time, but today I do. And that's sort of looking at the role of competition in here. And so we're looking at under amortization with impairment, our baseline counterfactual showed that valuations would sort of drop by 4.3%. So, but this also means we are holding the competition and the competitive environment constant here. But you would think that in equilibrium, if financial bidders know that the strategic bidders now bid less aggressively, maybe they become more likely to also join the auction and try to acquire a company. And so we try to see what happens if we were to increase the fraction of financial bidders in such an auction, or if we just add an additional financial bidder. So the gray column here is you add one, like you increase the number of bidders by adding one financial bidder, and doing so will sort of mute the effect of the goodwill amortization. However, if the effect is, well, you take out one strategic bidder and you add in one financial bidder, that would sort of amplify the effect of the accounting change. But overall, what you can sort of see is if you compare the impairment with adding one financial bidder, that only would add sort of 2.2% to deal premium. So this means the accounting standard is actually more important than the competition in these auctions. And with Sony, saw your hand up. Sorry, I think you're on mute still.
So, can you hear me?
Yes.
Okay, so my question might be a little bit off, but when you compare impairment only and then the other extreme is amortization only, the difference between the two regime is how much flexibility in reporting decisions that management can have. I tried to think about how that's incorporated into your surplus equation. Like, is it valid? Like, you know what I mean? Like, amortization is a systematic, just, recognition of the cost versus impairment. Managers have flexibility, to some extent to recognize these expenses. And I think strategic investors also prefer this flexibility in accounting choices and whether there's any room for this model to incorporate that issue.
No, that's a very good question. So in terms of flexibility, you can think about two sources of flexibility here. Sort of the first one goes to the purchase price allocation, like how much goodwill do you allocate in the first place? And then the second one is probably the one that you're alluding to, which is in the subsequent valuation. Like if you do amortization, well, you have nothing that you do, but for the impairment, you could potentially delay the impairment of a goodwill, right, in goodwill, or if you want to take it in terms of sort of a big bath, you take it earlier when the CEO changes. That's sort of the idea. You have sort of like opportunistic impairments.
Right.
So the managers and bidders in our model cannot, like, we don't allow them to do anything like that. So there's no explicit misreporting or reporting choices that these managers can make. However, when the manager builds the expectation about the future, this expectation we cover by estimating what's the actual incidence of impairments in the economy right now. And to the extent that opportunism is used, that would still show up in these expectations.
I see.
Yeah. Peter?
Hi, thanks for the presentation, very interesting. So it seems to me that you've kind of flipped the Jeremy Stein signal jamming story, which we normally think of in terms of incumbent management being myopic, and then the market understands the myopia and prices the myopia. And here you've got the acquirer being myopic with respect to earnings outcomes, and but it seems, what are you assuming, if anything, about the target management? I guess what I'm working around to is, whilst there might be real effects resulting from the accounting, because there may be a tendency for the acquirer to overpay, if the capital market understands the accounting, then the overpayment will be reflected in the acquirer's stock price. So in that case, why would the acquirer follow through on this overpayment strategy?
Okay, so I think I think there were sort of two components to your question. The first one about target. We're not assuming any, so we are not assuming anything about the management of the target. For the target, what we're assuming is that they will pick whoever submits the highest bid as the acquirer. That's the only thing we assume about the target.
So could it be the case that there are acquirers out there who understand the myopia of targets and bid high the targets they believe to be myopic in order to undo the myopia?
But that's on the side of the acquirer. So from the target's perspective, they will just take the assumption here is they will just take the highest bidder. But then there's sort of the question on, where is our sort of earnings fixation coming from, and is this caused by, and why is the myopia of the management not undone by the capital market? And sort of the assumption here is that there's some sort of so you could think about it as like flipping it from the Stein model, that you're sort of myopic trying to maximize the EPS number, or it comes sort of from a contracting perspective. So there's some sort of friction that causes that, and so we're trying to get into that at the moment when as we rewrite the draft, to sort of talk about that. It seems like these strategic acquirers, especially when they mention that this acquisition is made to increase earnings, tend to score lower on corporate governance measures. And that's why the discipline from the capital market cannot undo this myopic behavior. That's sort of the underlying assumption here.
Yeah, okay, that makes sense. Thank you.
We have 1 minute left.
Okay.
Yeah.
Yes, perfect. So I'll wrap it up. So what we do in this paper is we build a structural model to quantify the economic consequences of goodwill accounting. We show that this has implications for the size of the M&A market and potential distributional outcomes. And we hope that this is a first step in using these model-based evaluation techniques to help inform accounting standard settings. And I'm happy to stay along for a few more minutes. I see Catherine has a question.
Thank you. I see that you had to resort to saying that there's a corporate governance or a contracting problem that is necessary for you to get your results. And you have a lot of statements in here about accounting standard setting. And I'm curious, because this is a real question that I think academic accountants should think about. Do you believe that accounting standard setters like the FASB and the IASB should take account of problems in corporate governance in setting accounting standards? Or alternatively, do you believe that problems in corporate governance lie under someone else's decision-making jurisdiction and accounting standard setters should not take account of those? It's just something to think about.
Yeah. So I know that the corporate governance issues underlie a different jurisdiction, and the accounting standard setters are there to build standards that give us decision useful information. However, when we come to a topic like goodwill accounting, or for example, or other topics that become highly politicized, I believe that this type of research is useful to accounting standard setters because it can actually inform them in these type of debates, because the critics of the accounting standards will point to these economic consequences that are potential results of corporate governance failures that are not in the purview of the standard setters. But if the standard setters are being pulled into a political process, I believe that this can still be useful to standard setters, even though they don't, when designing the standard, shouldn't think about these types of issues because it's not under their purview. But that's my personal opinion.
And my comment was based on my personal opinion as well. Thank you.
Shall we wrap up and then?
So thank you all for all your comments and questions. And as Ayum said, there will be another one, accounting design next week by another Stefan, talking about corporate carbon accounting, balance sheets and flow statements.
Thank you.
Thank you.